The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Chip stocks rally, but not much else. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. on this Friday. And that's really all you need, Romaine, because take a look at this market. The S&P 500 higher by about 0.7%. The NASDAQ 100, where a lot of those chip stocks live, you can see it higher by 1.8% right now. You take a look at Brent, pretty much unchanged. We're hanging out around 105 right now and very slightly higher. And then the 2-year Treasury yield dropping right now. Looks like Kevin Warsh might actually get confirmed, and you can see that 2-year Treasury yield's down about 6 basis points.
Yeah, the green across your screen, a welcome relief for a lot of investors, particularly with the Philadelphia Semiconductor Index, which is actually outperforming the S&P for a 7th straight day and a 4th straight week, really indicative of the continued rotation out of that headline-driven rally in energy and industrial stocks and into what is now this CapEx-driven rally in AI infrastructure. Old school infrastructure, too. Yesterday, it was OG Texas Instruments having its biggest one-day gain since the year 2000. Today, it's Intel flirting with what could be its best day since 1982. Now, this is an AI story, to be sure, but more importantly, it's a show-and-prove earnings story, aided by structural shifts in business spending and aided by what has been a more than 10% war-induced correction for tech stocks, a drawdown that had pushed valuations relative to consensus growth expectations below that of the broader market. Some folks saw that as a buying opportunity that, for now, is being validated by some of the earlier-to-report tech names.
Right now, I'm not worried about rates. I don't think that's going to be an issue for the market. Valuations are totally fine here, 21.5 times earnings, given the earnings picture. And that's been our thesis all year. We haven't wavered on that, right? That this earnings recovery is a lot stronger than people think.
Mike Wilson also brushing off concerns about the narrowness of the rally and the narrowness of earnings, a point actually raised by Ben Snyder and his team over at Goldman Sachs, who said it has been kind of a slim pocket of strength with regards to earnings revisions that have actually powered this rally. They also cite a measure of market breadth that they show, Katie, has dropped to the lowest level in recent decades. Is that true? I
mean, if Goldman says it, I'm going to believe them. Let's talk a little bit more broadly here. When we take a look at the chips, which has really been the bright spot of this market, you can see that all of the consternation that we're seeing when it comes to oil prices, chips just shaking it off here. You have the Philadelphia Semiconductor here in index in white, and then in blue you have Brent oil futures. And you can see that maybe in March you did see a little bit of a hiccup. That chip rally that we've been talking about did cool off a little bit during that initial spike. But then you fast forward to April and you can see that Brent, it's staying around these levels. Can't say the same for the stocks. Absolutely soaring. That has been backed up by earnings to this point. Romaine, it's going to be interesting, of course, to see how this trade develops as we get into some of the other tech names next week.
A lot going on in the world. A big day, of course, for U.S. equity market. So big, we had to fly Peter Oppenheimer in from London. He's the chief global equity strategist and head of macro research Europe over at Goldman Sachs. Great to see you in person, Peter.
You too, Romaine. Thank you.
First, I want to actually start off with this tech rally that we've seen of late. And I want to go back to a note that you and your team put out earlier in April, kind of talking about that drop that we saw in valuations and how, to a certain extent, the underperformance, if you will, of some of those names relative to the rest of the world kind of maybe opened up an opportunity for folks to come back in.
Absolutely. I think what really happened is you began to get value in growth parts of the market, just as you were seeing growth in some value parts of the market. The infrastructure plays on the rolling out of AI. And, you know, people had obviously got very worried about disruption from AI models, particularly in software businesses. But that had really generated one of the biggest deratings we've seen in the sector for decades and actually left them quite cheap relative to the underlying profit growth, which we're seeing validated, I think, now being really very strong.
When I look at the tech rally, the U.S. tech rally over the last 3 or 4 weeks or so, and I was looking at the biggest gainers, and it's kind of interesting. A lot of the names aren't the ones you would think, the NVIDIAs, the Microsofts, if you will. It's kind of, you know, old school companies like Texas Instruments, Intel, which a lot of people had sort of given up for dead a while ago, and a lot of other names, you know, memory chip makers, et cetera. What is that telling you about the nature of this rally?
Well, I think you said it, it's old school. You know, really, if you look at the period from the financial crisis all the way through to 2025, 15 years, it was really dominated by the new economy. technology was outperforming all other sectors, and for that reason, the US was outperforming all other markets.
Yeah.
It was all about growth. No one wanted value. People didn't want things in the old economy. So those parts of the market were, as you say, left for dead for many decades. There wasn't much investment. Now you're getting this ramp up in capex by the hyperscalers. It's really integrating their reliance on physical assets around them, chips, but also data centers, energy supplies and distribution, and that's creating this sort of rotation in the market. And it's not all about growth and value, but different parts of growth and some different parts of value working together.
Well, I do want to talk a little bit about energy stocks, especially in the context of what we've seen transpire since the start of March, because, you know, that had been the big outperformer in the markets. And there was a lot of optimism when it comes to the earnings season, what we were going to hear from some of the energy names. And it's still early, but I mean, you take a look at earnings so far, and they haven't quite met consensus, or maybe surprised a little bit to the downside. So I wonder, you know, if you think about oil staying around these levels for a while here, what that means for the sector as a whole.
Well, the sector has re-rated a lot, of course, because it's very sensitive to oil prices. And as you say, oil prices, although they've gone up a lot, have sort of stabilized, and we think they're going to average in the low 80s this year. That's obviously helpful, and it will be, I think, supported by stronger earnings. But that's a relatively cyclical factor. I think what's really interesting about energy is more, again, energy infrastructure, because the longer-term secular story here is all about energy independence, which many countries are having to pursue, particularly, for example, in Europe, where I come from, but also the need to increase energy capacity to meet the demands of more electricity for AI. So I think the longer-term story here in energy is going to be about infrastructure and building out capacity.
That's really interesting. What's, you know, separating the cyclical from sort of the more structural themes within energy. And I wonder, you know, how that nuance matters when you're putting together a portfolio. I mean, how does that sort of impact portfolio construction, the subsectors that you're looking at when you are looking at energy? Yeah.
Well, the way I would look at this really is a broad diversification. You know, again, if you go back to the 10, 15 years after the financial crisis, equity markets were really driven by bifurcation of factors and regions. The US was constantly outperforming everything else, and it was led by tech. It didn't really matter what tech. Software, hardware was all rising together. And value, whether it was infrastructure plays or old school, you know, old economy building type stocks were doing very badly. And I think what's happening now is you're getting a much more layered and differentiated market, even within the same sectors. So if you look, for example, at the difference in performance between hardware and software in technology, it's radically different. And within the old value parts of the market, again, you're getting very different performances between the infrastructure plays, which are benefiting from the capex from AI, and some other areas like autos, for example, or consumer cyclicals, which are doing much less well. So I think it's a sort of more subtle play.
But when you look at global markets for the rest of the year, does this become much more of a U.S.-driven global market? Because the narrative for the first 3 months with the outperformance we were seeing in Europe and Asia, in emerging markets, that gap has narrowed pretty significantly, certainly with regards to developed market nations. And I am curious as to whether this is temporary and maybe we'll start to see that non-U.S. outperformance once again?
Yeah, well, back in late 2024, we did argue that you would start to see it broadening out geographically. And in fact, through 2025 and the beginning of this year, most non-US markets did outperform the US. That was partly because of the derating in tech, which dominates the US market, but it was also because you were getting some stronger growth drivers in other parts of the world, fiscal boost in Europe and Japan and so on. But actually, if you look at it relative to underlying growth rates, if you take PEG ratios, for example, the US and the rest of the world have kind of converged. And so I think the US is looking more attractive again. But you are seeing, I think, selected very attractive opportunities in parts of other markets. So it's having, again, selectivity and diversification that I think investors should focus on.
Before we let you go, I am just curious about the headline risk of whatever is going on in the Middle East right now. The market seems to have put it behind them, or at least the worst case scenario. Have you?
Well, our view has been that the overall growth impact on our central assumptions, that you start to get an opening up of the Straits by mid-May, is not that big. You know, we think it would reduce global growth by about 0.4, increase core inflation by about 0.2, slowing growth rates a bit, but still pretty decent. We're still looking at global GDP growth this year of about 2.7%, pretty benign.
Yeah.
And with slightly higher inflation, nominal GDP, pretty strong. And that's really what equities are making a claim on.
Yeah.
So I think it's right, unless the disruption of the Straits continues for much longer, the overall growth effects vis-a-vis profits, company profits, is relatively modest, I think.
All right, Peter, great to catch up with you. I have to leave it there. Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs, with stocks right now in the S&P, the NASDAQ, and the SOX at record highs. This is Bloomberg.
Well, it's been an eventful Friday on the Fed front. The U.S. Department of Justice dropping its probe into Fed Chair Jerome Powell, potentially clearing a path to confirm Kevin Warsh as his replacement, just in time for next Wednesday's FOMC decision. Let's unpack it all with Ben Harris. He is Vice President and Director of Economic Studies over at Brookings and former Assistant Secretary for Economic Policy and Chief Economist at the U.S. Treasury Department. Ben, fantastic to have you with us here. So, I mean, you think about the news that we got this morning, the DOJ dropping its pursuit here. Is it safe to say that this Kevin Warsh confirmation looks like a lock?
I don't think it's quite safe to say that yet. I think it would be a lock once you have indication from Senator Tillis that he's going to remove his hold on Kevin Warsh. And I think that you also need a letter from the DOJ saying that this has been resolved. So it's a positive development for today, but I think we're far from a resolution.
Far from a resolution here. And we also heard from U.S. Attorney Jeanine Pirro saying that she expects a report soon from the Fed's Office of the Inspector General and that she will not hesitate to restart a criminal investigation if the facts warrant it. How much do you put into that? Do you take her at her word here, or do you think that this is just saving face at this point?
Well, I take her at her word, but the statement is fairly clear that she won't hesitate to restart that investigation. And Jerome Powell has been very clear that he needs absolute certainty that this investigation will not start. So when I read Pirro's statement, that doesn't read like absolute certainty to me. I think we need that letter from the DOJ or some other form of certainty before Powell steps down and before Tillis removes his lock. Once that happens, the other interesting question is whether or not Jerome Powell will actually stay on as governor. And, you know, within D.C. circles, this is one of the top areas of speculation right now.
Well, let's go there because, I mean, this is the parlor game everyone seems to be playing, not just in Washington, but on Wall Street as well. Let's assume for a second he does stay, Ben. What does that mean for the debate on policy?
Well, I think that Jerome Powell is one of the most credible people I've dealt with in Washington, D.C. He just has so much integrity. And if you're trying to decide what Jerome Powell might do, I think the right question to ask is what's in the best interest of the Fed? So if he does stay on, my guess would be, and I haven't had any discussions with him, but my guess would be that he would try to depoliticize this whole process. And so what does depoliticization mean in this context? My guess is it means announcing a date past the midterms by which he would stay, and then after that point he would leave. But the challenge for him is making this feel less political, making it feel like it's less guided by the White House, like he's not being pressured out. And that's a very tough thing to do with this White House.
I am curious, too, about when we have this debate about where monetary policy might go. And obviously the speculation is that given the pressure President Trump has put on the Fed, given that he picked Kevin Warsh for specific reasons that we may not completely know of, the betting markets right now are saying, look, rates are going to go down. There is going to be an easing of policy in some way or another. Do economic conditions warrant that, though? I mean, when I look at the economic data, I look at sentiment indicators that we get today, it's still a very mixed picture. And then, of course, you have the inflation bugaboo now because of the war in Iran. The
biggest question right now is what's going to happen with the war in Iran, as you just said. I can tell you what I think is going to happen with the U.S. economy if you can tell me how many ships are traveling through the strait. Right now, there's just such a fantastic level of uncertainty around that question. It's tough to really make any sort of policy. It's tough to invest as a U.S. business. It's tough to speculate about monetary policy. And it's probably tough to be a member of Congress because we just don't know where the U.S. economy is going. When it comes to monetary policy, I think markets are pretty clear. They expect one cut by the end of the year. But as you can see in the stock market today, that expectation is also tied to a resolution in the Gulf. And that's a big if.
Yeah, a lot of big ifs out there, certainly. I do want to talk a little bit about another if, and that brings us back to the Federal Reserve, because, as you said, still a lot of unanswered questions here when it comes to whether or not Kevin Warsh will be confirmed. But, I mean, if you look into the future and you do imagine a hypothetical situation where Kevin Warsh is installed as the next Fed chair, I wonder, how that Federal Reserve might look different beyond what's going to happen with interest rates. I mean, you think about his views on the balance sheets, on forward guidance. I mean, what kind of world can you imagine there?
So I think the best way to think about a Warsh Fed is to go back to what the Greenspan Fed looked like, where you had more traditional monetary policy. You don't have discussions around quantitative easing. You don't have the Fed buying long-term treasuries. You have more flexibility around the communications, so you're not locked into press conferences. I think that overall it looks a lot like the Greenspan Fed. And Kevin Warsh, to his credit, has signaled exactly what he wants that to look like. So he's given a fair amount of guidance as far as how he'd like to run the Fed. The bigger question is around monetary policy. I mean, I think that Warsh is probably between a rock and a hard place where he probably made some sort of implicit commitment to the president around being a dove for the next 2 years while President Trump is in the White House, and he has to honor that commitment. But at the same time, if you look at his record, he's quite clearly a hawk. And so my guess is we'll see over the next couple of years a transition path between being kind of a moderate dove to a moderate hawk.
Ben, great to catch up with you. Ben Harris, they're a former chief economist at the Treasury Department, now vice president and director of economic studies at the Brookings Institution, as we continue to count you down to those closing bells with a big look at, well, a big rally. A rising tide lifts all ships, and we are seeing Intel do just that with the chip sector. That conversation coming up next after the break, right here on Bloomberg. Time now for our top calls. The big movers on the back of analyst recommendations. Let's start with DraftKings. MoffettNathanson downgrading to neutral. This after a more than 30% drawdown in the stock that the analyst says, well, still doesn't see the clouds lifting anytime soon. The stock, though, rallying for a second straight week. Next up, we got to talk about Intel. Morgan Stanley lifting its price target to $73, maintaining an equal weight. The raise comes on the back of that surprisingly strong earnings report that supports the thesis that the tech industry also ran is back at center stage. Those shares now headed towards their first record high in almost 26 years. And those Intel results precisely the reason behind the next upgrade. D.A. Davidson raising its call for AMD to a buy, increasing the price target to $375. Joining us now to talk a little bit more about that call is the man behind it. Gil Luria, D.A. Davidson, head of technology research, joins us now to discuss. And let's get right to it here. I thought you said something very succinct in your note, particularly on AMD. The idea here that you actually thought that CPUs were going to be the next big bottleneck. And it seemed like what we heard from Intel last night seemed to ratify that in a big way.
Yeah, and boy, is it happening fast. If up until a day ago, Intel's rally was entirely based on deal making. There really wasn't any improvement in the fundamental results, not in any significant way. And yesterday, the report of the first quarter was spectacular in their context, because of this demand for CPUs. And this is something that's just happened very recently. Up until, I would even say, December of last year, almost all of AI was done on GPU compute. But once we started using agentic AI more over the last few months, all of a sudden there was a lot of need for CPUs to just execute tasks. And we knew that demand was rising. We didn't know that it was going to rise so quickly to a point where not only did Intel have all this ability to sell more and sell at a higher price, they talked about selling previously written down chips.
Right.
That's manufacturing speak for we took it out of the trash and we were still able to sell it.
One man's trash is maybe that same man's treasure if you wait long enough. But Gil, I want to understand your call a little bit more because you're upgrading AMD here on the back of this report from Intel, but you're keeping your neutral rating on Intel, as I understand it, though boosting the price target. Square that circle for me. Why not just upgrade Intel as well?
Because Intel still has a lot of risks ahead. Again, 1 quarter of good execution based on a rising tide doesn't mean all the problems have been fixed. That tells you how quickly the tide is rising, that even a rickety boat like Intel has been rising with it. We think investors are better off with AMD, which has been executing very well and has that same exposure to CPUs. Just to give you some sense, Intel's surprisingly good gross margins were 39%. AMD's already at 55. And the most important metric is actually on the manufacturing front, on the fab front.
Yeah.
For every dollar TSMC gets in revenue on the fab, it makes 50 cents of profit. For every dollar Intel gets from its fab, it loses 50 cents. So 50% positive margin for TSMC, 50% negative margin for Intel. Can Intel execute its way out of it? We're optimistic. We want them to succeed. Lip Bhutan has started to orchestrate a phenomenal turnaround, but there's a lot of risk where AMD is already executing and has that same exposure to CPUs as well as an exposure to GPUs. And let's not forget, they signed OpenAI as a massive customer there, Meta as a massive customer there. So they're guiding for 35% growth for the next 4 or 5 years, so through 2030. That's a lot of reason to get excited. And now we know they're going to get all this additional benefit from the CPU market.
Just real quickly, Gil, we only have about 30 seconds, but does all this potentially come at the expense of GPUs and what NVIDIA has been building, or is this going to all coexist?
Oh, this is in addition. We still need all those GPUs, and we're going to need TPUs. We need a lot more compute. We're all using AI a lot more in our personal lives and at work. And that means a lot more compute, a lot more GPUs, a lot more CPUs.
Rising tides. It's lifting GPUs, CPUs, you name it. Gil Luria, great to see you. He is D.A. Davidson's head of technology research. And coming up, a shakeup in the credit scoring space. We're going to discuss what it means for home buyers with the president and CEO of Vantagescore next. This is The Close on Bloomberg.
This is the countdown to The Close. I'm Romain Bostic.
And I'm Katie Greifeld, keeping an eye on the broader market, but also keeping an eye on shares of FICO. Down this week, but really, they've had a horrible 2026 so far.
Yeah, rebounding a little bit on the day, but of course, taking it on the back foot. And this has to do a lot with a lot of the rhetoric that had been coming out of Washington for quite some time about trying to kind of break the stranglehold the FICO and the other companies that had on the credit scoring business as well. Basically trying to open up the aperture a little bit to allow other companies to provide their models as well.
Yeah, and I mean, FICO has had a stranglehold here and has certainly enjoyed that incumbency advantage. And you can see that expressed in the shares. I mean, again, year to date, down about 40% or so. And you are seeing some of their peers fall as well.
Yeah, and we should point out that that rhetoric did finally become reality. On Wednesday, we did actually hear from the FHFA and HUD basically announcing what is pretty much a big structural shift when it comes to credit scoring in the mortgage space, a big shift that could actually benefit our next guest, who says that the move will result in the modernization of the mortgage industry, delivering reduced mortgage risk, reduced costs for consumers and mortgage lenders. Silvio Tavares is president and CEO of Vantagescore and its models, singled out as one of the folks here that will benefit from the broadening of that aperture. Silvio, great to have you on the program. I think the last time we spoke to you was when there were rumors swirling about the potential for the federal government to actually sort of formalize what they had been jawboning about. Were you aware that this was coming down the pike this week?
Well, yes, there were two key points that were made in the press conference with the FHFA director and the Secretary of Housing and Urban Development. And the first point is that Fannie Mae and Freddie Mac are ready to accept Vantagescore for now. They had made that decision a year ago, but what they announced Wednesday was they are ready to go. All systems are go. Vantagescore can be used for all conforming Fannie and Freddie mortgages. That's about 50% of the mortgage market. The second piece of news that we heard was that the FHA, which is within the Secretary's Housing and Urban Development Department, they too have announced that they will accept VantageScore 4, and that's new. HUD loans account for about 20% of the mortgage market, and VantageScore will be able to be used for those as well. Big news, the bottom line, significant cost savings for mortgage lenders and American consumers. We expect about $1 billion just in the next 12 months from competition for credit scoring.
Yeah.
The other big news is greater access to mortgages. We expect over $1 trillion in new mortgage volume to be allowed to credit-worthy consumers. It's great news for the American consumer, great news for the mortgage market, and more generally, great news for the economy.
Well, before we go deeper in this conversation, I do want you to just articulate the difference between VantageScore 4.0 in terms of how it actually sort of measures your credit worthiness, because this was a big issue of debate here relative to what we saw with some of the more traditional, long-standing credit scoring companies.
The key here, Romain, is that the VantageScore credit score is quantitatively, empirically better. It enables the mortgage lender to use more modern credit report data. We call that trended data. And it also uses alternative data, including rental payments. This is critical because these data sets enable a more accurate measurement of risk. And so the bottom line is it's a better score, and it improves substantially the ability for mortgage lenders and mortgage guarantors, like the government agencies. It enables them to measure risk more effectively. It's a big, big deal, great modernization that benefits all the parties in the mortgage ecosystem.
And yeah, you take a look at some research coming from the Urban Institute. They found that Vantage scores on average are about 14 points higher than classic FICO scores. And it's interesting to hear the breakdown in what you're looking at there when it comes to putting together that score. So talk to us a little bit about those additions that you made. You know, the idea that you're going to factor in rental, that you're going to factor in utility payments as well.
Well, that's the challenge, is that, you know, some of the industry forecasters don't look at the data accurately. It's much better to rely on the publicly reported data and analyses done by third-party research firms and the largest banks. What they conclude is that VantageScore, in fact, predicts more delinquencies and actually has a lower average VantageScore. The average VantageScore through the end of March was 701. We score on a scale, minimum score of 300. Highest score 850. Our competitor uses the same scale. And if you look at our average credit score, it's 701. If you look at their average credit score, it's something more like 713, 714. So it's their score which is higher and looser. Our score is more predictive. And in fact, your own analysis at Bloomberg Intelligence in a separate group has shown that during times of volatility, our score identifies up to 15% more delinquencies, mortgage delinquencies. So the score is more modern, it includes better data, and because of competition, we're able to deliver significant cost savings to both mortgage lenders and consumers at a time where, let's face it, the mortgage market is tough. So it's perfect timing as well.
I take your point. Just to be clear, I'm citing data from the Urban Institute. Those are their findings. But Silvio, I do want to follow up on what you're saying about, you know, how this could impact affordability. You think about the housing market in this country. Certainly, a lot of folks have felt locked out of that. You've seen the average age of first-time home buyers rise as well. So draw the line there between, you know, this decision and what you view as the next step towards housing affordability.
Well, the reality is, as you point out, is that the mortgage industry and the housing industry is in crisis. It's one of the key ways that Americans are able to access the American dream and live their best financial lives. What VantageScore does is it enables mortgage lenders to back the right consumers that are in fact credit worthy. And we do this by using modern analytical techniques, but also better data and more data than the incumbent score. Look, the incumbent score has been around for over 30 years. You know, when you look back back at the financial crisis, that was the score that was used. It hadn't been modernized. It hadn't been updated. Now that monopoly over that score is over. May it rest in peace. It's time for competition. It's time for better, more modern credit scores to be used. And that's the decision that the FHFA director made. That's the decision that the Secretary of Housing and Urban Development made. And we applaud them. And as you can see in the data, the markets applaud this decision. It's really important, and it's just in time.
You know, Silvio, I do just want to get your take, though, a little bit on the health, though, a little bit more of the mortgage market. And I know you're not an economist, but this idea here that with mortgage rates at, you know, basically, 6.3% or so on average, the idea, and then home prices continuing to go up here. I mean, there is not a lot of options for a lot of folks out there, even if you have good credit, to even to be able to afford into a home unless you are extremely high income. Does that change anytime soon? Are you seeing any sort of relief in any other pockets of the market?
Well, I think the reality is that the mortgage market is quite complex. The housing market is quite complex. We can't say that one thing solves the whole challenges and is the panacea. What we can say is that with using better data and analytics, we can more effectively pinpoint the consumers that are credit worthy. And when we do that using the Vantage score, it reduces the risk for the overall system, and it reduces the cost to access mortgage financing for the overall system. That's a good result, and is in fact why the regulators made this decision. Using Vantage score reduces risk. It reduces the overall cost to the ecosystem, and that ultimately means more American consumers in homes. And that's what we all want. That's what the market wants. And we can't forget that housing is a key driver of the economy, and it's a key driver of affordability. And that is the objective here, and that's what these decisions deliver.
All right, Silvio, got to leave it there. Congratulations there, Silvio Tavares, the president and CEO of closely held Vantagescore. When we come back, we turn back to the public markets and take a look at Eli Lilly, down for a second day, down for a second week. Slow uptake for its weight loss pill. We're going to discuss coming up next in our Stock of the Hour, right here on The Close on Bloomberg.
Our Stock of the Hour today is Eli Lilly. Shares down on the day with the company's weight loss pill off to a slow start relative to Novo Nordisk's competing Wegovy pill. Now, it sets up a challenging race in what could be the next frontier of weight loss medicines, or at least how people are taking them. Let's discuss with Bloomberg biotech reporter Gerry Smith. Gerry, great to have you with us. So it's interesting to see Eli Lilly reacting so negatively here, given that, I mean, this pill of theirs, it's only been on the market for 2 weeks, and that's not very long.
Yeah, I mean, this is like the first full week that we even had prescription data, and it just goes to show you how closely investors are scrutinizing this competition between Lilly and Novo. That, you know, analysts pointed this out today, but then also said, you know, you need to be cautious. You can't really draw big conclusions from such an early point in a drug launch. But, you know, there's just such a frenzy over these new pills that everyone is watching the prescription data very closely.
I mean, we talk about, what is it, 3,700 prescriptions for the most recent week of data that we have here, and that compares to Wegovy, which has been out for a little bit long, the oral version, 125,000 here. Do we have any sense here about the potential marketing push that Lilly might put behind this, where after a few more weeks, that gap starts to narrow?
Yeah, I mean, you know, Novo's weight loss pill was one of the most successful drug launches ever. So it's a challenge for Lilly to try and catch up with Novo. You know, Novo obviously had a head start, and their pill was on the market before. But, you know, this is just a space that both these companies are going to be fighting with each other for quite a while. This is really the new frontier of weight loss drugs, is these pills. They're easier to take. And so, you know, I think this is going to be, analysts still say this is going to be a very, very large market.
Right. And we only have about a minute left with you, but put this in the broader context of the Eli Lilly versus Novo Nordisk race here, because Eli Lilly had taken the lead from Novo when it comes to the U.S. weight loss market. And it feels like this has definitely been a needed win for Novo overall.
Yeah, that's right. I mean, Novo was, you know, an early pioneer in weight loss drugs and really lost its advantage to Lilly with the injectable weight loss drugs. And now, this is a new playing field with the pills. And, Novo was out first and has a large lead, but it's still very early days, and analysts are saying, we need to be a little cautious about drawing major conclusions before we decide on Lilly's launch.
All right, Gerry, really appreciate your time. That is Bloomberg's Gerry Smith. Eli Lilly lower, Novo Nordisk shares higher, and we do have some merger news, potentially, Romaine, as well.
Shares of iHeart actually halted right now. Shares of Sirius XM down about 6%. A report here that iHeart has been holding talks about a possible combination with Sirius XM. This according to people familiar with the situation that our reporters have spoken to. Of course, this is radio and podcast. We know radio, terrestrial radio, even satellite radio.
Yeah. Things we care about.
Been hurting a little bit.
Absolutely. Well, we'll bring you more details as we have them. This is The Close.
I think the US is looking more attractive again, but you are seeing, I think, selected very attractive opportunities in parts of other markets. So it's having, again, selectivity and diversification that I think investors should focus on.
Peter Oppenheimer over at Goldman kicking us off to the close just about 50 minutes ago on what is setting up to be a record day for the S&P, the NASDAQ, and the Philadelphia Semiconductor Index.
It's a big rally, but not a broad rally. I mean, you take a look at the S&P 500 right now, you have pretty meaningfully more losers than winners, but the winners that are winning, they matter. It's a lot of those chip names that we've been talking about. You can see that in the NASDAQ 100 as well. And you can see Brent also moving a little bit higher on the day. That is not derailing things at the equity index level. Brent higher by about 0.9%. And you are seeing two-year yields drop. I mean, we were talking about this with Ben Harris, that Kevin Warsh confirmation. It's not a lock, but you can see that the bond market's still placing its bets.
I think it's interesting, too. I mean, we talk about the tech stocks rallying, but some of the big gainers in the S&P today are actually in the commodity space as well. Newmont, I think I saw Baker Hughes and a couple others. Halliburton is up there as well. So it's kind of interesting to see what people are actually gravitating to. But have you ever run like the rotation graph, the RRG on the Bloomberg terminal?
It gives me a headache when I look at it.
Okay, well, energy is doing this, going down, and tech is like doing this up. So I'll draw a diagram for you later.
Yeah, please.
In big, bolder, fat colors there. As we move closer to those closing bells, just about 8 minutes away, Steve Sosnick joins us here in Studio 2, the chief strategist at Interactive Brokers. All right, Steve, I first want to start with what's going on in the moment. We've had two really, I guess, old tech companies just absolutely having phenomenal days. Texas Instruments yesterday, and obviously Intel today. We're in an 18-day rally in the semiconductor index. But this is a relatively narrow rally when we talk about the broader market. It's kind of being led primarily by chip stocks, not even broad tech, but really chip stocks. What is that telling you right now?
It's telling me, number one, that this is the companies that we thought were left for dead are not. They're not dead yet. I mean, and Texas Instruments and certainly Intel was basically given up. It needed a bailout. Less than a year ago. So things there. It's telling you that if all this money is being spent by the hyperscalers, and there are concerns that they're borrowing too much and changing the balance sheet, so we could spend an hour on that, but the money's being spent somewhere, and it's not only necessarily on the high-end chips like NVIDIA or Broadcom. They're buying the workaday chips, and they're using the old-fashioned fabricators like Intel just to get. They need product. They need to fill a data center.
And just a reminder for our viewers, I mean, next week we're going to hear from some of those hyperscalers, Microsoft, Amazon, Alphabet, Meta's in there as well, and a couple others I'm probably forgetting. So we're going to get to see their CapEx guidance, hopefully. Most people assume they're going to hold on to that. Is that what's holding up the market right now? Because you would think with everything going on in the Middle East, a lot of economic indicators that suggest things aren't necessarily good on Main Street. Is this really about CapEx spend and business spending keeping this market afloat?
I would say yes. Look, when you look at the type of companies that are leading the rally, whether it's hyperscalers really aren't leading, but it's 18 days in a row. That's insanity. That's. I tried to look for a historical precedent for that, and I couldn't find one. I think the longest previous streak was 9. Wow. And even during the internet bubble, I could only find like 5 or 6 day streaks. Wow. So this is like beyond anything. We're up 40 some odd percent. I don't have the number right in front of me because we're up again today. But as of yesterday, when I ran the numbers, we're up 42% in the semiconductor index in, call it a week and a half.
Yeah.
2 weeks. I'm sorry, 2 weeks and a half. That's crazy.
Well, Steve, how does that fit into this generational dichotomy that you say that you view among investors in the notes that you sent over to our producers? Because it seems like there's a lot of enthusiasm in this market, and it sort of depends what you're hearing based on what demographic you're talking to. It
absolutely does. And, you know, I think when I talk to people, let's say, who are of a certain age, like mine, the questions tend to be like, what the heck is going on? It's usually not a G-rated word either. Yeah. What's going on? What is? Explain this to me. We didn't really go down when the war started. You know, 7 to 9% is not really what anybody had in the cards, and this rally coming back on a stalemate, not a victory, or even a constructive end. How do you explain this to people who, let's say, came of age after the global financial crisis? They understandably pretty much view every dip as a buying opportunity because in their investing history, it has been. And so I think, you know, the more you phase out the people of a certain age and the more you phase in people, you know, let's say of your age, Katie, then wow. I think that changes.
Sorry, Steve. Thanks you.
Well,
okay. Ramin, I think you're kind of in
stop.
You're in the middle.
Folks Romain and I's age, you know, conditioned to buy every dip. Here's the impossible question: who do you believe? I mean, which camp do you go with?
Well, first of all, one of the first lessons I learned, no matter how old you are, is don't fight the tape. Yeah. And right now, it's very difficult to fight it. Now, the problem I'm getting into, particularly with semis, is there's a finite percentage, finite probability that we're seeing a blow-off because you just don't get moves like this, 40%. You can't re-rate a whole sector like this quickly. Although each time they keep beating their guidance, you have to think that. So I wouldn't say this is the time to fight the tape, but I'm not putting fresh money into it because, you know, boy, there's the chart's literally vertical. Yeah.
Well, with regards to the market today, and particularly younger generation looking it through, given your wisdom and seniority, I do want to go back 30 years ago because I was just looking at the complexion. Let's just take the S&P, for example. Okay. We know today is dominated by the big tech companies, NVIDIA's, Apple's, Microsoft. You go back to 1996, it was GE, Exxon, Coke, AT&T, Royal Dutch Petroleum, Altria. You get the idea here. Yeah. Is that sort of also a function of why maybe the market is looking through whatever's happening in the Middle East? Because I feel like oil prices, energy prices, I know there's an economic feed through eventually, but it does not have the direct impact to the bottom line that might have would have had 30 years ago on the companies that were weighted at the top.
Absolutely. Yeah. We're not nearly, I think at that point energy was 20% of the S&P 500 or something of that nature, and now it's a much smaller percentage. You know, and we're driven by the tech stocks, and to be fair, one of the theses for investing in the Mag 7, as it were, you know, with a little reshuffling, was that these companies had, you know, bulletproof balance sheets and earnings statements. They had these phenomenal margins without much capital investment, without much balance sheet. Yeah. Well, that's changing because you know, if you're borrowing billions and billions to build the fixed assets of data centers, that changes your fundamental business. But again, it doesn't make you more oil dependent, but it does make you dependent upon other things. Yeah. And that's where I kind of get the sense of, you know, semiconductors go in cycles. And so, you know, are we seeing the best of the semiconductor cycle that we have now as they race to put chips in data centers?
Yeah, about 36% of that weighting today is just in the S&P information technology. If you add communication services, it's 45%. You go back 30 years ago, it was financial stocks, industrial stocks, energy stocks making up that 45, 50%. Steve, we have to leave it there. Always a great conversation. Steve Sosnick, Chief Strategist over at Interactive Brokers, counting us down to these closing bells with the S&P 500 at 7166 and change, heading towards what is going to be another record high. A full breakdown starts now in our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube on a day where the S&P, the NASDAQ, and the Philadelphia Semiconductor Index are on pace for yet another record high. The Russell 2000 only a smidge behind them.
Man, you stole my headline.
I tried.
What
was the headline, Carol? Was it the Sox?
No,
Yeah.
that the three were higher.
okay.
I mean, I'm obsessed with the Sox right now. Up for an 18th straight day. I think we're up about 50%, 50, folks, in that time frame.
Well, look at just how these companies in the Sox are doing. Intel's up more than 23%. ARM Holdings up, Katie, 14, almost 15%. Rambus up more than 14%. AMD up 14%. Qualcomm up more than 11%. It's pretty remarkable.
It is pretty remarkable. We keep remarking on it, and it's certainly benefiting the S&P 500 as well. I will note that this is the fourth straight week of gains for the S&P 500. It has gained every single week in April. Just amazing when you think about what we saw in March, and that was 4 straight weeks of losses.
A market really trying to look past some of the issues going on in the Middle East. And part of that is obviously because what we saw with some of these earnings this week, particularly with Intel, particularly with Texas Instruments. Don't forget next week, or a huge week, 181 S&P companies set to report, and it includes pretty much all of the big names at the top of the weightings, your Apples, your Microsofts, your Amazons, and Alphabets. We get the closing bells here in New York, and it does look like it is going to be a record day for the benchmark index. The S&P 500 right now trading around 7164 and change. It takes a while for these numbers to settle, but no matter how they settle, it's going to be up about 0.8% on the day to yet another record high. The NASDAQ Composite and NASDAQ 100 adding about 1.6% on the composite, 1.9% on the NASDAQ 100. That's good enough for a record high. The Dow Jones Industrial Average sitting this one out in the red on the day by about 0.2%. So are the Dow Transports and the S&P Equal Weight Index. The Russell 2000, though, it is going to finish in the green, up about 12 points or 0.4%, but just about looks like about 6 or 7 points shy of a record high.
All right, back to the S&P 500 we go. Remain, of course, breaking down all of those major averages. What's interesting is, yep, a record, but folks, only 177 names gaining ground in today's session in the S&P 500. Katie had 324 names losing ground today, 2 unchanged.
Yeah, you saw a similar breadth picture when you take a look at the sector level as well. When you take a look at that circle, 5 sectors finished in the green, 6 in the red. In terms of what did gain today, information technology higher by about 2.5% as a sector. Consumer discretionary also popping about 1.4%. Those are your big winners on the day. In terms of what didn't perform, healthcare down about 1.4%. We know that Eli Lilly has had a rough go of things lately. Industrials also down about 0.9%, Carol.
All right, guys, let's go to some of the individual gainers. No surprise, I'm going to go to the semiconductor area, including, of course, Intel just soaring on its blockbuster report. It is the #1 gainer in the S&P 500, the NASDAQ 100, up 23% in today's session. But not alone. You had ARM, AMD, Qualcomm, all of these names higher in today's session, up almost 15%.
Can I just give you the stat there? Best day since October 29th, 1987. I don't know if you're old enough, Carol, if you remember what happened in October 1987.
Yeah, I wasn't around.
I remember what happened that day.
What happened?
That was Black Monday.
It was Black Monday.
Yeah.
We were talking about the Dow back then.
The Dow, I know.
And look where that got them.
Yeah, look at it now.
All right, so thank you for that perspective.
Carol wants to continue talking.
Yeah, I would like to. All right, so anyway, stocks up for an 18th straight day. We're up nearly or around 50% in that time frame. Take a look, folks. I know for those who are listening on radio, but it is a straight shot up in the last 18 days. So quite some outperformance. We know about...
We were talking with Steve Sosnick earlier.
Yeah.
18 straight days, longest win streak for that index since it was formed back in 1994. He said that the longest streak prior to this was like 9 days. So basically doubled that daily win streak.
Yeah, I mean, it's really kind of crazy, and that is pretty significant if you look at that stat. I should also point out AMD was upgraded to buy from neutral, price target raised to
bring back on this day
375 from 220 at DA Davidson. Yeah, I'm just going to ignore him. Anyway, we're going to move on. Let's go on over to Alphabet. One more name for you. Google's going to invest $10 billion in Anthropic with another $30 billion potentially to follow. A $350 billion valuation now. So we just continue. Alphabet shares, you can see, up about about 1.5%. And I just want to mention, don't get mad at me, Finley, but Spirit Aviation was up 46%. Again, it's like $1 something a share about, again, some talk about the government maybe taking a position. And then iHeart holding merger talks with Sirius. iHeart, it was stopped because of volatility in trading, but when it stopped, it was up about 14%. So I'm just going to throw those in.
If the U.S. government buys Spirit, do we get a discount flying it?
That's a great question.
Why would we?
Or do we get to bring a check? Do we get to bring a bag without paying?
I thought we were going to talk about the U.S. government buying iHeart, and I thought that was going to be interesting, but who knows?
Hey, we got some decliners, even though today was such a risk-on day. I want to start with the worst performer in the S&P 500. Charter Communications fell by more than 25% today. This after the company reported underwhelming quarterly results. It lost 117,000 residential customers at its Spectrum Internet brand. Once again, the worst performer, losing a quarter of its market cap just in today's trading session.
That's the biggest drop ever.
That's a big one.
Yeah, since 2009.
Wow. Okay, let's move on to HCA Healthcare. This company also fell today by more than 8.7%. Was the decline. It opted against raising its yearly profit and sales guidance despite first quarter profit beating analysts' views. Remember, it's a hospital operator, so first quarter admissions were lower than expected due to a decline in people going to the ER or being admitted with respiratory illness. HCA Holdings falling 8.8%. And finally, Avis Budget Group, ticker CAR.
I love this story.
Down 11% today.
Wow.
It's wiped out nearly all of its 600% surge over the previous month in just 2 days, Romaine.
Yeah.
No clear cause except,
Yeah.
The fact that it went up,
I guess.
a
Classic short squeeze.
71% drop just in the past 3 sessions.
So,
and there's a great story in the Bloomberg terminal that provides a lot of context for the run-up in the shares.
Well, remember, it went back to this idea of a government shutdown.
Yeah.
And people saying, wait a second, if the government shut down and you can't get through airport security, maybe everybody will drive everywhere instead.
Right.
And that was sort of the beginning of this run.
But that's a fundamental reason.
Yeah, I think there was a little bit more than fundamentals. I encourage everyone to read that story on the Bloomberg terminal. A quick check of yields here. We did see yields drop significantly, and that did help to aid the market rally, down about 6 basis points on the shorter end of the curve. Longer end of the curve, the moves were a little bit less dramatic here, but of course that is the setup. Don't forget, next week, next Wednesday, we do get a Fed decision day. No expectation for rates to move, but of course, a lot of speculation about what the debate will be about where we go next.
All right, well, I know where
Carol,
we're going to go
back to you.
right next. Thank you so
Sure
much,
thing.
Romaine. I really appreciate it.
What do you
What's
got?
up with you today, Romaine?
Did you hear this story, Carol, about the pandas that apparently are being flown back?
Did you hear that one?
Oh, there it is.
Could
Look at
someone
that.
kill his mic? So anyway, listen, we're thinking about what's going to happen with the war between the U.S. and Iran this weekend, as it looks like there's some movement forward in terms of peace talks. But I wonder if geopolitically, our next focus is those talks between President Trump and President Xi, which are expected to happen in mid-May. Ahead of that, China is sending 2 pandas to the U.S., adding to perhaps some signs of stabilizing ties between the two nations before
Didn't
that
they just
meeting.
take pandas from us or something?
It's been back and forth.
Panda diplomacy.
So are these the same pandas or?
I think these are new ones.
These are new ones.
This is
because
Zoo Atlanta.
They have some issues procreating here. So
Zoo
how do they get
Atlanta.
too
Well,
many
you got to
pandas?
keep track of the names. Zoo Atlanta says a male panda named Ping Ping and a female named Fu Shuang are part of an agreement with the China Wildlife Conservation Association. It replaces the original one that expired back in 2024.
The agreement,
according to
not
Zoo
the
Atlanta.
pandas.
Yes, the
Right.
agreement. Exactly.
Thank you.
I remember being in D.C. when the pandas came to the National Zoo there. It was like a frenzy. I mean, you would have thought like BTS or somebody was in town.
They're fine.
They're fine.
I'm not huge.
They just
on
kind of roll
pandas.
around, they eat their bamboo.
Yeah, they don't really do much.
Ignore their
They're pretty
lovers,
ferocious,
you know,
though. They
whatever.
look awfully cute, but
They're definitely not procreating. We know that for sure.
They take a
But
lot of coaxing.
let's talk a little bit
we all?
about another story that we were
Speak for
keeping an
yourself.
eye on. This is called the Tin Can. Apparently, it's
What?
the hottest phone for kids right now. It's a $100 landline. The device.
I'm sorry, what?
It's,
$100 landline?
well, it's a landline-inspired device.
all right.
Hundreds of thousands have been sold, apparently, mostly thanks to word of mouth. And it's to try to get kids off smartphones, is my understanding.
Did Charter Communications come up with this or something? What's happening?
You know, there is a big line. There's a big line for these. I think my brother sent a message to our family chain and was like, his kids have a birthday coming up in a few months, and he's like getting on the wait list for these.
Wow.
Yeah, imagine when they find out what we actually talked on, you know, when we were kids, how we talked on the phone.
I know. I actually, well, Carol and I, back in the old black and white days, we used to have, real tin cans with the string on
the
them.
dial.
It was
We
quite
actually
things,
had a party
Hard to
line.
hear.
We had neighbors up on the hill that we shared a line with. It was kind of
Yeah.
weird.
Carol and I used to run around back in the 30s.
Yeah.
We were like little rascals.
We were like
It's
this.
like, and how?
We were like this. All right, guys, that is a wrap. Have a great and safe weekend. Yeah, big sigh there. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine continuing there, of course, on TV, on The Close, and Tim and I right back here on Bloomberg Business Week Daily. We will see you again, same time, same place, on Monday.
Maybe.
A big week up ahead for big tech. Qualcomm, Amazon, Alphabet, Apple, Microsoft, Meta, just some of the names scheduled to report earnings. We're going to set you up for what to watch there with Lindsey Bell over at 248 Ventures. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. That relief rally has actually turned in, well, quite frankly, a real rally led by tech and led by chip stocks. The S&P 500 closing at another record high, up for a fourth straight week now, 71.65 and change. You take a look at the Philadelphia Semiconductor Index, a 4% gain on the day. That's part of an 18-day run, a big lift, at least this week, from Texas Instruments and from Intel. Meanwhile, some of the sectors that actually had rallied over the last few weeks, those are the ones being sold off. You take a look at the KBW Bank Index, down about 1% on the day. And how about defense stocks? The S&P Aerospace Index, which includes a lot of the names that were supposed to benefit from the conflict in Iran, also being pulled back a bit here on the day and on the week.
How about it? Let's take a look at some of the individual movers at the equity level here. Some late-breaking news. Some late-breaking reporting, that is, when it comes to SiriusXM, a potential merger with iHeart. You can see that sent Sirius shares down about 5% into the close. Also wanted to highlight Eli Lilly. We were talking about this a little bit earlier. Of course, the early data when it comes to that obesity pill uptake may be a little bit less rosy than what we saw for Novo Nordisk, but it's only been on the market for about 2 weeks. Nevertheless, shares down about 3.7%. And Intel, holy moly, looks like we did close at that record high for Intel, which reported about 24 hours ago. Shares finishing the day more than 23% higher. And that is our top story this hour. Intel's surge fueling gains across the tech sector as investors brace for the busiest week of earnings this earnings season by market cap next week. Meta, Microsoft, Amazon, and Alphabet set to report Wednesday with a combined AI expenditure of $650 billion this year. Results from fellow Mag 7 member Apple due on Thursday, just a week after the iPhone maker laid out succession plans for CEO Tim Cook. Lindsey Bell, she is chief investment strategist over at 248 Ventures. She joins us now to discuss. And Lindsey, you think about the week we have coming up, specifically the 2 days within that week that we have coming up. I'm already tired thinking about it, but you think about expectations, how they have evolved over the past few months, especially with the outbreak of the war in Iran. How does this all set us up for what we might hear in the days to come?
Yeah, I mean, it's going to be a really important week because tech earnings really are the real reason that earnings expectations for this quarter and for 2026 have moved higher. Of course, we've seen energy materials numbers move higher too, but every other sector is down a bit, which is normal, nothing to be worried about there. But tech is going to be a big component of that. I will say a lot of this higher earnings, and obviously the stock market has been driven by the semiconductor sector, and we can see why with Intel's report this morning.
Yeah, absolutely. And I do want to pick up, too, when it comes to that CapEx expenditure that I mentioned, because you think about the past several cycles of earnings season reports, and that has turned into a little bit of a bugaboo, like an existential concern, whether or not we are eventually going to see a return on that investment. Do you think that that narrative is still an overhang for this space, or have we started to move past it?
I think it's still an overhang, especially as we get into next week, given the Iran crisis is ongoing. I think investors are really going to look to this sector, and the Mag 7 in particular, and their CapEx spend, how that's being monetized, as really a tell of of how the AI economy is evolving. Obviously, we got good news today, but we're going to hear we want to hear from these mega cap stocks about what they're seeing from a demand and supply perspective and how they're navigating that situation, but most importantly, really how they're driving monetization. I will say the one thing about these stocks, we've seen them run in the last couple weeks. They've been key drivers of the markets, which is never good, by the way, going into earnings season. You don't want stocks popping before they can report numbers. But I would like to see evidence within earnings and their outlook that move can continue. These are stocks that are still very high quality. You have to understand that cash flow growth may be declining, but the Mag 7 are still going to have over $50 billion in free cash flow in 2026.
I am curious, though. I mean, there has been some discussion, Lindsey, if you will, about just the cost for this rollout. I mean, obviously, the hyperscalers have been very upfront about their CapEx spend. They certainly seem to think that that's going to pay off. But then when you start to hear about layoff announcements at Microsoft and Meta and some of these other companies that, at least based on public reporting, seems to be tied to the idea that they need to find a little bit more cash between the couch cushions to sort of make all this work here. Does that become, at least in the short and interim term, a potential risk for valuations?
You know, I think it is interesting. We saw what Meta said. They said they are, doing these layoffs to help fund other initiatives. And so I think it's a concern, but you have to remember what AI is, right? AI is a productivity booster for the economy across industries, and we're just going to start to see it first here. If I look at the overall economy, layoff levels still are very low. Of course, when you hear 10,000 or 20,000 jobs being lost between Meta and Microsoft over a one-day period, it does feel alarming. But you've got to remember these are still low numbers by the overall grand scheme of the economy. But it is definitely something to watch. And I think as long as these companies are seeing margin improvement, cost improvement, and potential monetization, that investors are going to look through it, at least for now, unless these layoffs get substantially bigger in the months or years ahead. I do also just want to go back to this idea, though, of the high expectations, because some of those expectations aren't as high, certainly for some of the non-chip stocks. I mean, we talk about this phenomenal rally, but if you just go back from the last earnings report, Microsoft's still in the red over the last 3 months, and the gains that we're seeing on Amazon, Apple, we're talking single-digit percentages, 2, 3, 7, 8%, which would be significant in any other moment. But when Intel's rallying 60, 70% over that time, and Texas Instruments and NVIDIA and all these other stocks here, what is that telling you about just, I guess, where the puck might be going in investors' heads? So I think a lot of the conversation, especially later this week, has been about, okay, we're back in risk-on markets at new all-time highs. But what I would say is this risk-on market is not as broad as what you'd like to see in a real risk-on market. Yes, semiconductors are having outstanding performance and the earnings support it. You are seeing the small cap, which also has earnings to support that sector. But some of the other cyclical sector, early cycle sectors like consumer, housing, they're not participating in. Even the mega cap tech stocks, like you said, on a year-to-date basis, they're just hanging in there. And some of them are in the red on a year-to-date basis. So that's really why I think that this earnings season next week is really going to be important for those names to show that they can pick up the momentum and be part of the stock and be a part of a broader market rally. So I really will be watching those closely.
Lindsey, always a pleasure. Lindsey Bell, Chief Investment Strategist over at 248 Ventures, talking about the momentum in the stock market. But there's also some potential momentum going on when it comes to inflation. We are scheduled to get PCE numbers next week, and the analyst estimates of what to expect, well, it's going to be quite the surge. That's largely because of the big jump that we've seen in energy prices. We're going to catch up after the break with Pipeline CEO Katica Roy on why she thinks the middle class is being hardest hit by the oil shock. This is Bloomberg. Keeping an eye on the situation in the Middle East, keeping an eye on the price of oil. Brent crude prices holding above $100 a barrel for yet another week, up over 15% just over the last week and well above where it was before the war began at the end of February. Our next guest has warned that $100 a barrel oil, that oil shock is hitting the middle class like a margin call, actively draining the American wallet. Katica Roy joins us right now. She's the CEO of Pipeline. And Katica, I do want to start there. We're going to get some PCE numbers next week. And I was just looking at the average estimates of economists. If you take the headline number, I know normally we look at the core number, which strips out food and energy, but on a headline basis, we're talking about a 0.7% increase year over year in that headline number. On a month-to-month basis, it's like 0.3%. Those are increases that we have not seen in ages. And I am curious about the actual impact on actual consumer spending, on the economy. And I know you've been taking a closer look at that specifically when it comes to middle-class households.
Absolutely. So, you know, when oil hits, when we see an oil shock, we ask what it means for the Fed, but households ask, how are we actually going to make the math work this month? And that really is the middle class margin call. So we've seen women's earnings have really accounted for the majority of all middle class income gains for the past 40 years. And when an oil shock hits, it's actually hitting the demographic that is least able to hedge that hit. And that is a risk for the solvency of the U.S. economy.
And also kind of dovetailing with that data for next week, we got data this morning out of the University of Michigan with regards to a sentiment here that is effectively, I think, at a record low based on their measurements here. And they're tying that, again, directly to the inflationary impact. And again, it's not just energy, it's food, it's a lot of other things. It's housing as well here. So, I mean, historically, I mean, when you look at how households behave in that type of environment where inflation is high and sentiment is low, what happens?
Well, consumer spending ultimately collapses. So what you mentioned is that oil prices don't just hit a household once, right? They hit first in gas prices, then they hit groceries through diesel prices. Then we see things like plastics. So for instance, cosmetics, diapers, laundry detergent, et cetera, and then fuel surcharges. And then ultimately what we see is the pullback in consumer spending. We also saw a recent report to CNBC that 80% of American consumers are planning to cut their spending because of the increase in gas prices. I'll just add one other thing. You know, we've seen wages on average really outpace inflation, margin very small, but that has actually collapsed by 82% since the beginning of the war with Iran.
And I do want to talk about the labor market a little bit more directly, because you think about some of the headlines that we got this week coming out of the tech sector, specifically Meta, Microsoft planning layoffs, planning buyouts. We're talking about 23,000 jobs potentially affected in total. And, you know, I wonder when you start to see these types of news stories, whether you think that there could be more to come, especially when it comes to tech.
Absolutely. So we are projecting this year record levels spending on artificial intelligence. It's over $600 billion, I believe, at the last number. And right now what's happening is that 66% of companies early this year talked about the fact that they're going to freeze hiring. We saw that obviously with the news out of Meta yesterday, freezing 6,000 open positions. And that's in order to take care of that margin. The issue is that we actually need those middle managers to make sure in the age of agentic artificial intelligence and you know, autonomy that we're actually ensuring that they're not going off the rails.
It's interesting to hear you say that because, you know, the conversation about AI, how it might impact the labor market, a lot of that conversation is focused specifically on entry-level roles. But what you're saying is it's basically that middle layer, those middle managers that are potentially at risk here.
And that's exactly what we've seen. So since 2022, we've seen a decrease of 42% in middle management roles. And over the next year, the projection is that those roles will be cut by over half. So that is the middle layer, not just folks, you know, entry level coming right out of school. And so who is actually going to manage these agents?
Yeah, it's a big question, and we'll have to see how it all shakes out. But it's great to talk through some of this data with you, especially ahead of that jobs report. That is Katica Roy. She is the CEO of Pipeline.
Yeah, and I'm curious, too, about this idea, the impact on white-collar jobs. And there have been a lot of kind of studies coming out trying to speculate as to the potential impact on this, whether that will have a material economic impact as well here. So far, a lot of these companies are kind of dismissing that, saying that we're not taking jobs, we're augmenting. You'll have an agent by your side.
It's additive. You know, you're going to love it. Don't worry about it. You're going to keep your job.
Oh, okay. What if I don't?
That's a you problem.
Okay.
Let's talk a little bit about what we have coming on up next, and that is the countdown is on to the Fed decision next week. We're going to discuss it with Betsy Duke. She's a former Fed governor. That conversation up next. This is The Close. The DOJ dropping its investigation into Chair Powell and the building renovation cost overruns over at the Fed. The move potentially now clearing the way for Kevin Warsh to be confirmed as the next chair, as investors now turn their attention to Wednesday's Fed rate decision. Joining us to discuss, I'm pleased to say, is Betsy Duke. She is former Fed governor and former chair of Wells Fargo. And we probably should start with that DOJ investigation being dropped. As we were discussing earlier in the show, there's still, a lot of question marks, not necessarily a done deal when it comes to Kevin Warsh getting that confirmation. But would love to hear how you're thinking through things, especially as we get closer and closer to May here.
So I think it's really good news. It's good news for the Fed, and it certainly demonstrates the commitment to go ahead and get Kevin Warsh through. I think Senator Scott was very smart to have the hearing. Kevin did well in the hearing, and so I haven't seen anything we've heard from Senator Tillis, but if this clears the way for Senator Tillis to allow the confirmation to go through, I think he'll be confirmed, and hopefully he'll get some Democratic votes.
Yeah, I think we would all love to hear from Senator Tillis at this juncture. But I mean, if you look into the future, I am curious what you think a Kevin Warsh Fed might look like. A discussion we were having earlier was not so much around interest rates. That debate has been had and had again. But, the idea that we could see a Fed that holds fewer press conferences. We get much less in terms of forward guidance. Do you think that that's a possibility?
I think a little bit of that is more semantics. So the number of press conferences that the chairman has is up to the chairman. The chairman will decide that. And Kevin may realize after he starts down that road that that's a chance for him to make his voice heard over all of the other conversations from all the other members of the FOMC who are also out making speeches. So Kevin may decide to do more press conferences than he thinks right now. As far as the forward guidance, the economic projections have been in there since the Greenspan days, and so they may stay. I've never been a huge fan of the dot plots, and Kevin may decide to get rid of those.
Yeah, and I'm curious also about that, too, given just kind of the complexities that we're in right now with the economy, Betsy, just what purpose the dot plot and even some of the forward guidance really serves. I mean, it kind of felt like at the last press conference, Powell even kind of quipped about the idea of, don't put too much stock in all this. Do you think, given what we don't know about the economic impact of the war in Iran, that this might actually keep the Fed at bay with regards to doing anything for the next few meetings?
I think it's going to be very hard for the Fed to do anything right now with not knowing about the war, not knowing how the gas shock is going to feed through to inflation, still not really knowing how tariffs are affecting inflation, and staying in a labor market that's steady. It's low hire, low fire, but still pretty steady.
So when they go in there, well, obviously next week they're going to have this debate, but really over the next couple of meetings, that debate will probably intensify as we get more economic data. I know there's been always this talk about, trying to balance that dual mandate. But where do you think this Fed will lean? Do you think they will pay a little bit more attention to labor market weakness, potentially at the expense of inflationary pressures?
So for each individual person in that room, that trade-off is different. And so right now, the discussion in the room probably is not necessarily what are we going to do now, but each person in the room saying, this is the way I'm looking at it, and these are the signs or these are the catalysts that would make me change my stance and feel like we should go in one direction or another.
But when you take a look, on either side, a hike or a cut, when you take a look at all those different cross currents, it seems like the consensus in markets is that this is a Fed that's going to be on hold for a while, or they should be. Do you agree with that analysis?
I do agree that they should be. I think they need some sort of sign one way or the other as far as where they might go. And to go back to your comment on forward guidance. So forward guidance, when I was there, referred to forward guidance that usually was in the statement itself. And it would say, we are not going to move rates up until this condition. That was for forward guidance. The dot plots are something different, and they are just sort of each individual's estimate of where things might go, and they're quite confusing. If you notice, Jay Powell has used them in that if they agree with what the conversation in the room was, he'll tend to point to them, and if they don't agree with what the conversation in the room was, he tends to discount them.
Well, I am curious, though, too. I mean, there was a lot of talk. I feel like it was back in the Bernanke days about going to kind of some kind of staff forecast format. And I know that's kind of bubbled up from time to time again. I haven't followed it closely enough. Whatever happened with that idea? Was that kind of dead on arrival? Has there been sort of any potential progress that maybe that might be an avenue of sort of providing some sort of public guidance without necessarily being as rigid as maybe some people view the current guidance system?
There were a lot of attempts to do a staff forecast, a consensus forecast, something, but there are just so many different voices in there. It was really not possible. There was discussion of, should you identify what the chairman's projections were aside from others, or should you identify everybody's projections? There just isn't a good way to do that, frankly.
All right, Betsy. Well, we always appreciate getting your insights here. Of course, this will be the parlor game for the next few Fed meetings. Betsy Duke, former Fed governor there. And just a reminder, of course, we do have the Fed Decides coming up this Wednesday, and we'll have full coverage of that right here on Bloomberg Television with Team Surveillance leading that on Wednesday afternoon. Absolutely
looking forward to hearing from Chairman Jerome Powell himself as well. But let's take a look at how markets closed out on the day, because, boy, it was a big rally, as you can see, with the S&P 500 higher by about 0.8%. A lot of that strength coming through when it comes to tech, when it comes to semis. The NASDAQ 100 higher by nearly 2%. And semis, as I mentioned, the stocks higher by 4.3% on the day. It certainly helps that Intel was higher by 23.6% in the wake of earnings finally hitting that record high. This is The Close on Bloomberg.
All right, a potential major change is coming down the pike here in the U.S. investing landscape. It may arrive later this year in the form of private assets in your 401k retirement plan. Our next guest says state and local pension funds that already make use of alt assets don't necessarily do much better or have higher returns than more traditional vehicles. Whether it comes or not, there's a big debate going on right now as to whether it's even appropriate. Joining us right now is Damon Jones. He's Associate Director of the Stone Center for Research on Wealth Inequality and Mobility at the University of Chicago, and he's done a lot of research into this space. Thanks for joining us today, Professor. I do want to start off with the idea, and let's just be clear here, at least based on Bloomberg reporting, this does appear to be a done deal. It is probably going to happen. I guess the question is, are rank and file investors, those folks in these defined contribution plans, their 401k, are they ready? Are they ready for this, Damon?
I would say the typical investor is going to face a lot of challenges figuring out private equity and cryptocurrency. And so I would be hesitant to advise anyone to venture into those types of assets. The other question is, what about the managers of these funds? They're supposed to act on the behalf of those investors. And there's some question there about whether they are ready to, evaluate these assets in a prudent way. And then there's also questions about, will they act in the best interest of those investors? And so prior regulations have been cautious about introducing these types of assets more broadly.
I mean, a big argument that has been made for giving individual investors greater access to this was the idea that for institutional investors, they've been sort of eating from this trough for a while now, enjoying double-digit percentage returns. The idea that if you really wanted to make money, it wasn't in the public markets, it was in these alternative assets. Do you see that? I guess, first of all, is that true? But also, does that carry over to what we could potentially see with 401k access?
I think that those higher than average returns may have been more common earlier on when these types of private equity investments were made available. It's not clear that over the last 20 years that those state and local funds that have access to these alternative assets, that they've been performing much better. And they still don't have a clear advantage over, a simple index. And so the evidence isn't, overwhelming that, they're making off that much better with the access to these funds.
Yeah, it is interesting. And, it's something I think about often when it comes to the conversation around private asset access is, you think about the returns here. Are you really getting something better when it comes to private markets versus what you could get in the public equity markets, the public debt markets, which have been, posting pretty respectable returns over the last several years, and you don't have that liquidity trade-off. A liquidity trade-off, Damon, which I imagine is less urgent when it comes to 401ks, but still exists.
Yeah, you want to hold that money for a long time for retirement, but there's also questions about transparency. How are you reporting the returns on these private investments, private equity types of assets? And so there's a little bit of lack of clarity about how well they are actually performing. And the other thing to make clear is that these types of pensions that have had access to these types of assets, they're a different deal for the retiree. A defined benefit plan is going to, pay out a very certain amount. With a DC plan, a 401k, the investor is, taking on all of the risk. And so the access to these riskier assets is going to be passed on to the investor in a DC plan in a way that it wouldn't be in a pension or some of these other public and state pension funds.
And I do want to go to a point that you make in the notes that you sent over to our producers, that you think about the managers of these retirement accounts potentially standing to benefit here from reduced exposure to litigation. Just talk us through, what you mean there.
Yeah, so I think that these assets, they've been available. It's been possible for them to use these assets in their funds for these 401k accounts and those types of accounts already. They've been very reluctant to do it because, there's been fear that they might face litigation from a class action lawsuit or something like that. So this regulation is going to give them guidelines that they can follow to get kind of safe harbor and avoid certain types of litigation or lawsuits. That's going to benefit them. You could argue that that could benefit the whole system by removing some of the legal frictions that might arise, but you might also worry about those managers not having as much accountability because of the shielding from litigation.
I'm just curious, just a final question here, and I just kind of want to get at the idea, just kind of the overall changes, the structural changes that we're seeing in just retirement accounts overall, not just with alternative assets, but, kind of the old day, maybe our parents' generation or our grandparents' generation. I mean, first of all, a lot of them are on, more of defined payouts plans rather than defined contributions. Then we kind of had the more staid 60-40, where you just kind of, over time, you just went from a big stock weighting to more of a higher bond weighting here. I mean, what do you think the future looks like with regards to asset allocation in some of these retirement programs?
Well, if this passes and, managers are more interested in using some of these assets, you might see the usage grow. It's probably going to be a slow, gradual change. And the reason why is a lot of people have their, as you said, they have their funds in these types of life cycle funds, things that are already kind of set. And so it may take a while for those changes to take place because of those kind of already set plans that people have made in their investment. So it's not clear that there's going to be an overnight change in how people are allocating their assets.
All right, Damon, we have to leave it there. Great to get some time with you. That is Damon Jones of the University of Chicago. And still ahead on The Close, the rise of drone delivery and the billions of dollars at stake in the expansion. We'll get to the heart of the matter with Matternet CEO next. This is The Close on Bloomberg. Time now for Next Up, where we highlight the entrepreneurs and trendsetters moving the needle in business and the economy. Our next guest runs the world's only FAA-type certified drone delivery company, Matternet, rolling out across the UK's healthcare system today. The California-based firm has also won backing from SoftBank Robotics and counts UPS, Ameriflight, and Dave's Hot Chicken among its corporate partners. Joining us live, I'm pleased to say, we have Andreas Raptopoulos. He is the founder and CEO of Matternet. Great to have you with us. Andreas. Talk to us a little bit about the expansion into the UK. You know, what it was like getting through the regulators as well versus, you know, stateside.
It's great to be here, Katie. Thanks so much for having me. Matternet is the only FAA type certified drone delivery company in the world. We have vast operational experience. We started operating over cities in Switzerland in 2017, here in the US in 2019 in partnership with UPS. We've operated in 9 countries. So when London, the Civil Aviation Authority in the UK, wanted to really move forward with drone delivery, they adopted the EASA framework, the European agency framework, and we were able to go very quickly through approvals. It took a few months, but we were able to demonstrate that we have the highest level of safety that is needed in order to operate in one of the world's greatest cities, of course.
Yeah, and it's interesting. I mean, you think about retail and restaurants, drone delivery there. You know, you can imagine your burgers flying through the sky. But talk to us a little bit about the healthcare angle here and, you know, what it takes to move blood and organs and other sorts of medical equipment versus, you know, a package that's mostly made up of food.
Yeah, we'd like to say that it's not a package, it's a patient, right? So a lot of times when we're transporting something, it's really, really critical. It will accelerate someone's diagnosis. It will get the chemotherapy treatment to a patient faster. So in order to be able to do this, you need very high levels of reliability in the whole of your service. And of course, you need very strong controls across the whole quality that affects the delivery of that item that you're delivering. So it's healthcare is one of these applications where impact per delivery is very, very high, right? And we're extremely proud to be working with one of the premier national healthcare systems in the world, and you know, really operating in the heart of London for 2 of the UK's busiest hospital campuses.
Mm-hmm. I am curious just about the evolution of this technology, Andreas, particularly as you move from maybe delivering kind of essential things like this in much more controlled drop settings. There's been a lot of talk, okay, how do you do this in, say, a dense urban area like a New York City or even, you know, central London, like in terms of going to doorsteps, not only making sure that the package gets delivered to the right place, but obviously, you know, I don't know what it's like in London, but, you know, in New York City, we got a little crime here, too. So, you know, some of those drones might not actually be safe. So I am curious as to how far away you think we might be from seeing this operating in more denser areas.
Yeah, I think 2026 is really an inflection year for drone delivery here in the U.S. We have a major regulatory breakthrough. It's called Part 108. It was announced from the White House last August, and it's going to become the rule of how the airspace works, the lower part of the airspace where we operate, in the next few months. This really is a massive catalyst for growth. So in the next few years, we're going to see exponential increase in drone deliveries in the U.S. There's probably 2,000 to 3,000 deliveries per day by drone in the U.S. today. I think that number by 2030 is going to be probably 3 to 5 million. And then, you know, there's going to be different architectures of how you deliver the service in different parts of, like, urban versus suburban, right? Matternet is very uniquely positioned for suburban. Mm-hmm. We have these autonomous stations that you just showed. Yeah. These stations can be used in order to put a package into the system and in order to send it to the other side or receive it. This works very well for B2B environments, but even for B2C environments, right? Imagine these types of assets distributed in different places inside our cities, in London or New York City. Yeah. When we fly in the airspace, this is like a federally controlled operation. So it's a federal offense to interfere with the aircraft. I think people understand this very well. And I think the conditions are here now to really unlock what we call the low altitude economy. So we're going to see massive, I think, increase in drone delivery in the U.S. and globally over the next few years.
And just real quickly, I only have about 30 seconds, but what about the cost effectiveness of this, particularly when you're delivering something? We kind of introduced you as, okay, you're delivering blood and things like that, but also, you know, hot chicken. I mean, is it cost effective to deliver me a chicken sandwich?
At scale, it is, yes. If you think about it, it's kind of crazy that today, you know, we use humans driving 2-ton vehicles to go across town to bring someone a sandwich, right? Yeah. This is highly, highly autonomous technology. The magic of this technology is that you have a fleet of drones, in our case, north of 20, being supervised by a human. There's very little human intervention. With our stations, we can pick up automatically.
Yeah.
So once you're able to eliminate the human out of the chain, cost comes down to how quickly can you scale your technology. And with the traction that we're seeing right now, we believe that is going to be much cheaper than any transportation method involving a human.
All right, Andreas, we have to leave it there. Really interesting stuff. Andreas Raptopoulos there, the founder and CEO of Matternet. You can get your lunch, Katie Greifeld, delivered by drone, maybe one day in the near future.
Fingers crossed.
Fingers crossed. We do want to set you up for what to watch over the next week. And we actually start on Monday with a big visit by King Charles III. Visiting the U.S.
Yeah, absolutely.
Yeah. I don't think that's going to move the market, but it will get a lot of attention. There's also that lawsuit, that trial for that lawsuit between Elon Musk and OpenAI kicks off. But let's get right to Tuesday here, because we get to the heart of it. A lot of economic data, a lot of earnings.
Yeah, U.S. consumer confidence. We also get a BOJ rate decision. That's the warm-up for what we get from the Fed. Earnings, too, from GM, UPS, and Starbucks. And that brings us to Wednesday.
The Fed rate decision at 2 p.m. Eastern time, plus a jam-packed afternoon of earnings from Alphabet, Microsoft, Amazon, Meta, and Qualcomm, just to name a few. And how about Thursday?
It's not over yet. Apple reporting on Thursday. Going to be fascinating in the wake of.
Do you think they're going to let John Ternus talk?
I have to. Maybe he'll make an appearance. I'm interested to hear that. We also get the ECP and BOE rate decisions as well.
Chevron and Exxon are going to round out their earnings week. More than 180 S&P companies are set to report, so could potentially move the market. We will have full coverage of that. Katie and I, right here on The Close, right here on Bloomberg.